In 2024, one of the world's most important cash machines began to sputter. For more than a century, the Suez Canal has been a narrow shortcut that quietly underwrote globalization. A thin ribbon of water linking Asia to Europe, carrying everything from oil and grain to toys and smartphones. And then, almost overnight, ships stopped coming, traffic fell, revenue collapsed. Egypt began losing hundreds of millions of dollars a month. But the real twist is this: the cost of that disruption did not stay in the desert or in Cairo's balance sheets. It moved silently through insurance premiums, fuel bills, longer voyages, delayed inventories, and eventually, it surfaced somewhere far more familiar: on price tags in supermarkets, in higher costs for small businesses, and in renewed pressure on inflation that many countries thought they had finally beaten. So how did a conflict thousands of kilometers away turn into a kind of invisible global tax? Who pays it? Who benefits from it? And what happens if the world starts to accept this as the new normal? To answer that, we need to slow down and look at how global trade actually works when it flows smoothly, and when it doesn't for decades. The Suez Canal was one of the great efficiencies of modern capitalism. Opened in 1869. It cut thousands of kilometers off the journey between Asian factories and European consumers. Instead of sailing all the way around Africa, ships could pass through Egypt in a matter of hours. Today, roughly 12% of global trade normally moves through this single choke point for Egypt. The canal is not just infrastructure. It is a lifeline. It generates billions of dollars in foreign currency every year, helping pay for food imports, energy, and debt service in a country that produces far fewer dollars than it needs. But a choke point is powerful precisely because it is fragile. When security in the Red Sea deteriorated, shipping companies faced a simple calculation: sail through a risky zone and pay more for insurance or avoid it entirely. Many chose the second option. They rerouted their vessels south, round the Cape of Good Hope, adding 10 to 14 days to journeys between Asia and Europe. On paper, this looks like a logistical inconvenience. In reality, it is an economic shock that ripples outward in slow motion. Every extra day at sea costs money. Ships burn fuel constantly. Crews must be paid. Containers are tied up longer, reducing effective capacity. Insurance premiums rise sharply in designated high-risk zones. None of these costs appear instantly in consumer prices, but they accumulate quietly, step by step. To understand why this matters, imagine a small furniture importer in southern Europe. Before the disruption, a container from Southeast Asia took about 30 days to arrive. Contracts were signed months in advance. Margins were thin but predictable. When ships began detouring round Africa, delivery times stretched toward 45 days. Fuel surcharges appeared. Insurance clauses were rewritten. The importer faced a choice: absorb the higher costs and risk going under, or pass them on. Multiply that decision by tens of thousands of firms across electronics, clothing, food, and industrial components. This is how geopolitical risk becomes inflation, not as a sudden spike, but as a creeping pressure. Meanwhile, back in Egypt, the consequences were immediate and brutal. Canal revenues plunged. For a country already struggling with high inflation and a weak currency, the loss of hard currency was devastating. Dollars matter because Egypt imports much of its food and fuel. When dollar inflows shrink, the local currency comes under pressure. When the currency weakens, imports become more expensive, and when imports become more expensive, everyday life becomes harder. In Cairo, this does not show up as an abstract macroeconomic indicator. It shows up in the price of bread, cooking oil, and medicine. It shows up in government budgets stretched thinner, forced to choose between subsidies, debt payments, and social stability. This is one of the cruel ironies of choke point economics. The country hosting the choke point bears enormous downside risk. Even though it has limited control over the forces that disrupt it, Egypt did not create the conflict that scared ships away, but it paid the price first. At the same time, not everyone lost. Periods of disruption often create unexpected winners. Some shipping companies were able to charge higher rates, insurers collected higher premiums, energy suppliers sold more fuel as voyages lengthened. The system, as a whole, was not optimized for resilience, it was optimized for efficiency. And when efficiency breaks, those who can reprice risk quickly often come out ahead. This raises a deeper question about incentives. Each actor in the system is behaving rationally. Shipping firms reroute to protect assets. Insurers raise prices to reflect risk. Retailers try to protect margins. Governments scramble to stabilize currencies and inflation. Yet, when everyone acts rationally in isolation, the collective outcome can still be worse for society. Economists sometimes call this a coordination failure. In practice, it feels like something else, a quiet transfer of costs downward, from global systems to households, from abstract risk to everyday expenses. What makes this story especially unsettling is how slowly it unfolds, unlike a sudden oil shock. Shipping disruptions filter through supply chains with long delays. Retailers may be selling inventory purchased months earlier, at lower transport costs, by the time shelves reflect the new reality. Consumers may no longer connect the price increase to events in the Red Sea. This lag creates a dangerous illusion. Policymakers see inflation easing and declare victory. Central banks begin to relax. And then, months later, prices start creeping up again, seemingly without cause. This is what some analysts are beginning to call geopolitical inflation. Not driven by demand overheating or monetary excess, but by structural insecurity baked into the arteries of global trade. And Suez is not the only artery. Compare this situation to other choke points. The Strait of Hormuz, where a large share of the world's oil passes, the Panama Canal, increasingly constrained by drought, the Malacca Strait, vital for East Asian trade. Each one is narrow, indispensable, and vulnerable. The difference with Suez is that its disruption does not just threaten energy. Supplies it touches almost everything. Finished goods, intermediate components, food. Europe feels it acutely because of its heavy reliance on imports from Asia. But the effects spread further into emerging markets that depend on stable trade flows and predictable shipping costs. Contrast this with countries that have invested heavily in redundancy. The United States, for example, has a larger domestic market and alternative ports. China has spent years building overland routes and diversifying logistics. These strategies are not cheap, but they reduce exposure to single points of failure. Egypt, by contrast, is structurally exposed. The canal is both its strength and its vulnerability when it works. It generates easy dollars when it doesn't. There is no quick substitute. This brings us to the human side of the story. In a port city in southern Europe, dock workers watch schedules change weekly. Ships arrive late, unload in bursts, then disappear again. Hours become unpredictable. Income fluctuates. In a Cairo neighborhood, a family adjusts meals because imported staples cost more than they did last month. These are not dramatic scenes. There are no explosions, no headlines, just slow erosion. And that may be the most dangerous aspect of all, because slow erosion does not trigger emergency responses. It becomes normalized. Businesses adapt by charging more, Consumers adapt by buying less. Governments adapt by borrowing more over time. The extraordinary becomes ordinary. So what can be done in the short term? There are only mitigations, not solutions. Naval patrols can reduce risk but not eliminate it. Insurance markets can spread losses but not erase them. Governments can subsidize vulnerable households. But subsidies cost money that countries like Egypt increasingly lack in the medium term. The conversation turns to resilience, diversifying supply chains, building buffer stocks, investing in alternative routes. Even if they are less efficient, these measures reduce vulnerability. But they also raise costs. Resilience is more expensive than efficiency, and in the long term. There is a more uncomfortable question. Have we built a global economy that is simply too fragile for a world of persistent geopolitical tension? For decades, the assumption was that trade would keep politics in check, that economic interdependence would discourage conflict. But the Suez disruption suggests a reversal. Politics is now reshaping trade. And trade is transmitting political risk directly into living standards. If this continues, the implications are profound. Inflation may become more volatile, growth more uneven, inequality sharper. As those least able to absorb higher prices suffer the most, countries that control chokepoints may demand higher compensation for risk or find themselves trapped by it. There are also choices. Governments can decide whether to treat logistics and shipping as purely commercial domains or as strategic infrastructure worthy of collective protection. They can choose whether to let costs trickle down invisibly or to make trade-offs explicit and debated. And there is a final, quieter choice, one that falls to societies themselves. Whether to accept that higher prices are simply the cost of a dangerous world or to ask harder questions about how that cost is shared. Because the story of Suez is not just about ships and canals. It is about how interconnected the modern world has become and how exposed. It is about how a conflict far away can shape the price of bread, the survival of small businesses, and the stability of nations. And it is a reminder that in a global system built on narrow passages, what looks like a detour on the map can become a turning point for millions of lives. If the world continues to sail through these choke points without rethinking the system behind them, the next disruption may feel less like an exception and more like the rule.